Qatari bank stocks are underperforming their regional peers in the wake of third quarter earnings. Sector trading at about 9/10 times the price to book versus 1.6 times in August last year. Let's bring in Edmond Christou, senior equity analyst for Gulf Financials over at Bloomberg Intelligence. Edmond, a pleasure to have you on this morning. Let's start with why Qatari lenders are lagging. Your thoughts?
Good morning. What we have seen is normalization of economic activity post the World Cup. We have seen a large spending prior to the World Cup in preparation for the World Cup, targeting specific sectors, and that has resulted in a large spending and lending activity within the banks. Now what we have seen since the World Cup is a muted lending activities, less spending happening domestically. On one hand, on the other hand, the interest rate is very high, borrowing cost is very high. It's very hard for this interest rate to be passed to the borrower as a consumer or a corporate, which putting pressure on the bank's interest rate margin, which has been underperforming other regional banks since last year. And Qatari Bank hasn't benefited from the Fed tightening of interest rate in terms of the bottom line.
What about the slew of risks we're trying to digest from geopolitics to the monetary volatility? What is that doing in terms of the outlook to Gulf banks?
So what we have seen geopolitical risk increasing in the last few weeks, and this will definitely have an impact on the financial sector in the region. The longer it takes for the conflicts, the longer it persists, and also there is a risk of a spillover beyond the borders that will have an impact on the global economic growth, will have an impact on the inflation and higher oil prices, which will result in a weaker asset quality for regional banks and more provisioning for these banks. So definitely there will be an impact, and what we have seen in our recent analysis published today is the real estate sector has shown more vulnerability to the geopolitical risk. If we look at the UAE real estate sectors here, the stocks has plunged around the 16%. Amar has plunged since October 6, 20%, while the banking sector has plunged only 4%. So clearly, investors are start to pricing in a fear of outflow of money, maybe slowing population growth in the region, and all depends on how this conflicts accelerate going forward.
And at the same time, Saudi banks, they tend to be forecast by a larger margin. On the other hand, though, Riyadh Bank, Al Rajhi, and our Arab National Bank, they just reported they were barely meeting those consensus estimates. Why not?
This is very interesting for the Saudi, and this is structural change in the Saudi market. We haven't seen ample liquidity in the Saudi market, despite having higher oil prices. So the Saudi bank has been struggling by mobilizing or gathering liquidity and deposit in the market, which is becoming very expensive given where the interest rate is, and also the depositor behavior is changing. Depositors are moving deposit from current account, which is non-interest bearing deposit, into time deposit, which usually looking into a higher interest rate for a higher yield. And this has impacted the cost of funding for this bank. On the other hand, they have a significant project pipeline of constructions. It's around the $600 billion over the next 5 years has to be financed from domestic liquidity, and the liquidity is not coming at cheap, which has resulted in a margin pressure and margin construction sequentially in the last 2-3 quarters.
Edmond Christou, senior equity analyst for Gulf Financials over at Bloomberg Intelligence. We thank you so much for your analysis this morning. Folks, plenty more still ahead. Stick with us. This is Bloomberg.